Folks, I need to tell you something that's been keeping me up at night. Not because I'm worried about my own money, mind you, but because of what I'm seeing happen to millions of people who think they've found the secret to getting rich quick. Right now, as we speak, Bitcoin is trading above $86,000. That's after falling from recent peaks over $100,000. The cryptocurrency market has lost over $1 trillion in value in just the past few weeks. And yet people are still buying. They're still convinced this is their ticket to financial freedom. But here's what nobody wants to hear. We've seen this movie before, 3 times actually, and it never ends well. In 1980, gold hit $850 an ounce. Everyone said it was going to $2,000, maybe $5,000. Then it crashed 65% and didn't recover for 28 years. In 2000, internet stocks were going to change the world forever. The Nasdaq lost 78% of its value. In 2007, housing prices could only go up. We all know how that ended. Today, I'm watching the same pattern unfold with cryptocurrencies. The same euphoria, the same certainty that this time is different, the same dismissal of anyone who dares suggest that maybe, just maybe, paying $86,000 for a digital token that produces nothing might not be the smartest investment strategy. Now, before you click away thinking this is just another old man yelling at clouds, let me share something with you. Back in 2018, when Bitcoin was trading around $9,700, I made a comment that got a lot of attention. I called Bitcoin rat poison squared. People thought I was crazy. They thought I didn't understand technology. They said I was too old to get it. Well, let me tell you what's happened since then. If you'd bought $1,000 worth of Bitcoin that day, you'd have about $6,600 today. That's a 560% return. Sounds impressive, right? But if you'd put that same $1,000 into Berkshire Hathaway stock, you'd have $2,348. That's only a 135% return. So the crypto enthusiasts are having a field day. They're saying I was wrong. They're pointing to Bitcoin's $1 trillion market cap and saying it's now worth more than my entire company. They think they've proven the old man from Omaha doesn't know what he's talking about. But here's what they're missing, and this is what I want you to understand before it's too late. I've been investing for over 70 years. I've seen every kind of bubble you can imagine. Railroad bubbles in the 1800s, radio stocks in the 1920s, the Nifty 50 in the early 1970s, Japanese real estate in the 1980s, dot-com stocks in 1999, housing in 2007, and now cryptocurrency in 2024. They all have the same characteristics. Prices that rise far faster than any fundamental justification. Universal bullish sentiment where everyone agrees prices can only go higher. New paradigm narratives explaining why traditional valuation methods don't apply. And finally, retail investor mania where ordinary people who've never invested before start putting their life savings into the bubble. Bitcoin checks every single one of these boxes. But Warren, you might say, Bitcoin is different. It's digital gold. It's a hedge against inflation. It's the future of money. Central banks are buying it. Major corporations are putting it on their balance sheets. I've heard all these arguments before in different forms with different assets, but the underlying logic is always the same. This time is different. The old rules don't apply. You just don't understand the new paradigm. Let me tell you what I do understand. Mathematics, and the mathematics of Bitcoin don't work. When I buy a stock, I'm buying a piece of a business. That business has assets, employees, customers, and hopefully profits. It produces goods or services that people want. Every year, if it's well run, it generates more cash flow than the year before. That cash flow can be reinvested to grow the business or returned to shareholders as dividends. When you buy Bitcoin, you're buying a digital ledger entry. It doesn't produce anything. It doesn't employ anyone. It doesn't serve customers. It doesn't generate cash flow. You're hoping that tomorrow, next month, or next year, someone else will pay you more for that ledger entry than you paid for it. That's not investing, that's speculation, and speculation works until it doesn't. Now, I want to address something that's been bothering me lately. Some of you have pointed out that Berkshire Hathaway owns shares in New Holdings, a Brazilian digital bank that offers cryptocurrency services. You've said this makes me a hypocrite, that I'm secretly betting on crypto while publicly criticizing it. Let me set the record straight. We invested in New Holdings because it's a profitable financial services company serving underbanked populations in Latin America. The fact that they offer cryptocurrency trading as one small part of their business doesn't make us crypto investors any more than owning Apple makes us a phone manufacturer. New Holdings has real customers paying real fees for real financial services. They make money whether Bitcoin goes up or down. That's completely different from buying Bitcoin directly and hoping someone else will pay more for it later. But I understand why people are confused. When you see new holdings stock up 125% this year, and you see Bitcoin hitting new highs, it's easy to think that maybe the crypto enthusiasts are right. Maybe I'm the one who's missing something. Here's what I'm not missing: the difference between a productive asset and a speculative asset, the difference between investing and gambling, the difference between building wealth and hoping to get rich quick. Let me give you some numbers that should worry anyone holding cryptocurrency right now. The total crypto market has lost over $1 trillion in value in recent weeks. Bitcoin is down nearly 35% from its recent peak. Ethereum has fallen 40%. Smaller cryptocurrencies are getting destroyed. This isn't unusual. It's happened before. In 2018, Bitcoin fell from $20,000 to $3,200. That's an 84% decline. In 2022, it went from $69,000 to under $16,000, another 77% crash. Each time, the true believers said it was just a temporary setback. They said it would bounce back stronger than ever, and they were right until they weren't. Here's what I want you to understand. The fact that Bitcoin has recovered from previous crashes doesn't guarantee it will recover from the next one. Past performance doesn't predict future results. That's investing 101. What worries me most is the leverage in the system. According to recent surveys, 38% of institutions with crypto exposure were forced to liquidate positions in 2024 due to liquidity issues. That means they borrowed money to buy crypto, and when prices fell, they had to sell at losses to meet margin calls. This creates a dangerous feedback loop. Falling prices force leveraged investors to sell. Their selling pushes prices lower. Lower prices force more selling, and so on. We saw this exact pattern in 2008 with mortgage-backed securities. We saw it in 1929 with stocks. We saw it with tulip bulbs in the 1630s Holland. The asset class changes, but the dynamics remain the same. Right now, we're in the euphoria phase. Bitcoin has a $1 trillion market cap. It's being compared to gold as a store of value. Institutional investors are piling in. Retail investors are mortgaging their homes to buy more. But euphoria always ends the same way, with a crash that wipes out the latecomers while the early adopters cash out and move on to the next speculation. The question isn't whether a crypto crash is coming. The question is when and how severe it will be. Based on the patterns I've observed over 7 decades of investing, I can tell you with reasonable confidence what's coming next. And it's not going to be pretty for the people buying Bitcoin at today's prices. Let me walk you through exactly how this crash is going to unfold, because understanding the mechanics might help you avoid becoming another casualty in what I believe will be one of the most devastating financial collapses in modern history. Stage 1 starts with something small. Maybe it's a regulatory announcement from a major government. Maybe it's a hack at a major exchange. Maybe it's simply that Bitcoin reaches $100,000 or $150,000 and stops going up. The trigger doesn't matter. What matters is that the price stops rising. You see, Bitcoin's entire value proposition is based on momentum. People buy it because it's going up. They hold it because they expect it to keep going up. When that momentum breaks, even temporarily, the psychology flips remarkably fast. The first sellers are the smart money, the hedge funds and institutions that got in early. They've made their profits and they're not emotionally attached to the narrative. They start taking profits quietly, selling into strength while retail investors are still buying the dip. Next come the leveraged speculators. These are the traders who borrowed money to amplify their Bitcoin positions. When prices start falling, their brokers issue margin calls. They're forced to sell, not because they want to, but because they have to. This selling pressure accelerates the decline. Then we get to stage 2. The real pain begins when Bitcoin drops 20 to 30% from its highs. This is when the ETFs start seeing massive outflows. Right now, Bitcoin ETFs hold billions of dollars worth of cryptocurrency. But ETF investors are momentum followers. They buy when prices are rising and sell when prices are falling. A 30% decline in Bitcoin triggers panic selling in the ETFs. Fund managers are forced to sell Bitcoin to meet redemption requests. This creates even more selling pressure in an already declining market. But the real devastation comes in stage 3. This is when ordinary people, the retail investors who bought Bitcoin because their nephew made money or because they saw it on social media, finally capitulate. These folks don't understand market cycles. They don't have sophisticated risk management strategies. They bought Bitcoin at $80,000 or $90,000 thinking it was going to $200,000 or $500,000. When they're down 50 or 60%, panic sets in. They sell at exactly the worst possible time, locking in massive losses. I've seen this pattern play out countless times. The dot-com crash of 2000 followed the exact same script. First, the professionals got out. Then the institutions cut their losses. Finally, the retail investors capitulated near the bottom. The mathematics are brutal. If Bitcoin falls 50% from current levels, you're looking at $43,000. If it follows the pattern of previous crypto crashes and falls 80%, you're looking at $17,000. And if it really collapses like I expect it might, a 95% decline would put Bitcoin at around $4,300. Now, some of you are thinking that sounds impossible. Bitcoin has too much institutional support, too much adoption, too much momentum to fall that far. Let me remind you of something. In March 2000, Cisco Systems had a market cap of $555 billion. It was the most valuable company in the world. Everyone said it was different because Cisco had real revenue, real profits, real products. It wasn't some pie-in-the-sky internet startup. Cisco fell 86% from its peak. Even today, 25 years later, it trades below its 2000 high. If you bought Cisco at the top thinking you were investing in a solid technology leader, you're still underwater a quarter century later. The difference between Cisco and Bitcoin is that Cisco actually produces something valuable. They make networking equipment that businesses need. They generate billions in annual revenue and profits. They pay dividends to shareholders. Bitcoin produces nothing. It generates no cash flow. It pays no dividends. Its entire value is based on the hope that someone else will pay more for it tomorrow than you paid today. When the music stops, and it always stops, Bitcoin holders will be left with digital tokens that have no intrinsic value whatsoever. At least with Cisco, you owned a piece of a real business with real assets. With Bitcoin, you own a line of code. Here's what really troubles me about the current situation. The people most at risk aren't wealthy speculators who can afford to lose money. They're ordinary working families who've been told that Bitcoin is their path to financial independence. I get emails from people who've put their kids' college funds into cryptocurrency, from retirees who've moved their entire 401k into Bitcoin, from young couples who've borrowed against their homes to buy more crypto because they're afraid of missing out. These people aren't speculators. They're not trying to get rich quick. They genuinely believe they're making a responsible investment decision based on everything they've been told about Bitcoin being digital gold or a hedge against inflation. The tragedy is that when this crash comes, and I believe it's coming soon, these are the people who will suffer most. They'll lose money they can't afford to lose. They'll have their retirement dreams shattered. Their children's education will be compromised. And for what? So some early Bitcoin adopters and crypto exchanges could get rich selling them a digital mirage. I want to be clear about something. I'm not rooting for Bitcoin to crash. I take no pleasure in the idea of millions of people losing their savings. But ignoring reality doesn't make it go away. And the reality is that Bitcoin at current prices is a bubble waiting to burst. The warning signs are everywhere if you know how to look for them. Extreme valuations disconnected from any fundamental value. Universal bullish sentiment where even skeptics are afraid to speak up. New money pouring in from unsophisticated investors who've never experienced a real bear market. Most telling of all is the leverage in the system. When 38% of institutional crypto investors are getting margin calls and forced to liquidate positions, you know the foundation is shaky. When people are borrowing money to buy Bitcoin, when they're refinancing their homes to get more crypto exposure, when retirement accounts are being shifted into digital currencies, you're not looking at rational investment behavior. You're looking at mania, and mania always ends the same way. The smart money knows this. That's why you're starting to see subtle shifts in positioning. Hedge funds are quietly reducing their crypto allocations. Some early institutional adopters are taking profits. The venture capital firms that funded crypto startups are shifting focus to artificial intelligence and other sectors. They're not announcing these moves. They're not going on television to explain their strategy. They're just quietly moving to the exits while retail investors are still pouring money in. This is exactly what happened in 2000 with internet stocks. The professionals started selling in early 1999, but the NASDAQ didn't peak until March 2000. The retail investors kept buying all the way up, convinced they were getting in on the ground floor of a technological revolution. They were right about the technology. The internet did change everything, but they were wrong about the valuations. Most internet stocks went to zero, despite the technology being revolutionary. Bitcoin might be revolutionary technology too. Blockchain certainly has applications, but revolutionary technology and good investments are two completely different things. You can be right about the future and still lose money if you pay too much. The people buying Bitcoin at $86,000 are paying too much, way too much. And they're going to learn a very expensive lesson about the difference between innovation and speculation. The tragedy of what's coming isn't just the money that will be lost, it's the trust that will be shattered. When Bitcoin crashes 95%, and I believe it will, millions of people will never trust financial markets again. They'll stuff their money under mattresses or keep it in checking accounts earning nothing, afraid to invest in anything. This is what happened after the 1929 stock market crash. An entire generation of Americans refused to invest in stocks for decades. They missed out on the greatest wealth creation period in human history because they'd been burned so badly by speculation masquerading as investment. The same thing happened in Japan after their real estate and stock bubble burst in 1990. Japanese investors became so risk-averse that they've missed every major bull market since. Their stock market is still below its 1989 peak, 35 years later. This is the real cost of bubbles. Not just the immediate losses, but the long-term damage to people's willingness to build wealth through legitimate investments. When Bitcoin collapses, it won't just hurt the people who owned it. It will hurt everyone by creating a generation of investors too scared to participate in markets. But there's something even more insidious happening here that most people don't understand. The crypto industry has become a massive transfer of wealth from ordinary people to insiders. Let me explain how this works. When Bitcoin was worth pennies, the early adopters accumulated millions of coins for almost nothing. These people, the so-called Bitcoin whales, now control enormous portions of the total supply. When they sell even small percentages of their holdings, it can crash the entire market. Meanwhile, retail investors are buying Bitcoin at $86,000 per coin, thinking they're getting in early. They have no idea they're buying from people who accumulated the same Bitcoin for under $100. The mathematics are staggering. Someone who bought Bitcoin at $10 and sells at $86,000 has made an 8,600% profit. The person buying from them at $86,000 needs Bitcoin to go to $860,000 just to make a 10 times return. This isn't sustainable economics, it's a pyramid scheme dressed up in technological complexity. The exchanges are making fortunes in trading fees while retail investors chase prices higher and higher. The mining companies are selling Bitcoin as fast as they can produce it, taking profits while electricity costs remain stable. The crypto influencers are being paid to promote coins they don't even own. Everyone is getting rich except the people actually buying Bitcoin at these prices. I've seen this before with different assets. In the late 1990s, investment banks were packaging and selling internet stocks to retail investors while their own traders were shorting the same stocks. The insiders knew the valuations were unsustainable, but they kept selling to greater fools until there were no more fools left to sell to. The same dynamic is playing out with Bitcoin today. The difference is that crypto markets are even less regulated than stock markets were in 1999. There's more manipulation, more insider trading, more outright fraud. Retail investors have even less protection. When this house of cards collapses, and it will collapse, the people who will lose the most are the ones who can least afford it. The wealthy speculators will write off their losses and move on to the next opportunity. The ordinary families who believe the hype will have their financial futures destroyed. This is why I've been so vocal about Bitcoin's risks. Not because I hate technology or innovation, but because I hate seeing people get hurt by obvious speculation disguised as investment advice. Let me share something with you that I learned from Benjamin Graham over 70 years ago. The market is a voting machine in the short run, but a weighing machine in the long run. Right now, the vote is overwhelmingly in favor of Bitcoin. Everyone thinks it's going higher. The momentum is strong, the narrative is compelling, the fear of missing out is intense, but eventually the market weighs assets based on what they actually produce, and Bitcoin produces nothing. Zero. It's a digital collectible with no more intrinsic value than a baseball card or a Beanie Baby. When the weighing machine takes over, and it always does eventually, Bitcoin's true value will be revealed, and that value is much, much lower than $86,000 per coin. I can't tell you exactly when this crash will happen. Markets can stay irrational longer than you expect. Bitcoin could go to $100,000 or even $150,000 before it collapses. Bubbles often inflate beyond what seems possible before they burst. But I can tell you with certainty that it will happen. The mathematical impossibility of Bitcoin's current trajectory guarantees it. You cannot have an asset appreciate 160 million% in 15 years and expect that trend to continue indefinitely. The numbers simply don't work. When Bitcoin does crash, it won't be a gentle decline that gives people time to get out. It will be swift and brutal. The same momentum that drove it up will drive it down, only faster. Leveraged positions will be liquidated. Stop-loss orders will trigger cascading selling. Fear will replace greed in a matter of days, not months. The people who think they're smart money today will become the bag holders of tomorrow. The institutional investors who bought Bitcoin at $50,000 or $60,000 will be underwater for years, if not decades. The retail investors who bought at current prices may never recover their losses. This is the harsh reality that nobody in the crypto space wants to acknowledge. They're all too busy making money on the way up to think about what happens on the way down. But gravity always wins eventually. What goes up without fundamental justification always comes down. The tragedy is that there are legitimate ways to build wealth over time. Ways that don't require gambling on digital tokens or hoping for greater fools to buy your speculative assets. Ways that have worked for generations of successful investors. Look, I've been investing for 7 decades and I've seen this movie too many times before. Bitcoin at $86,000 isn't an investment opportunity. It's a wealth destruction machine waiting to happen. The mathematics don't lie, the history doesn't lie, and the warning signs are flashing red for anyone willing to see them. Don't be the person holding the bag when the music stops. Your financial future depends on it.